Okay, let's jump right into this explainer. Today, we're going to see if a totally new school, tech driven health insurer can actually pass an old school value investing test. We're putting our financial analyst hats on, and we're combining Warren Buffett's classic qualitative framework with some seriously rigorous quantitative valuation to bring a full, definitive thesis to the table. So, we're literally asking Warren Buffett's foundational question here: is this a wonderful business at a fair price? And to figure that out, we are leaving the hype at the door. We're applying a strict scorecard, digging purely into their SEC filings and the raw data to see if this company actually deserves our capital. Here's our exact roadmap for today. We're going to define their moat, tear down the financials, build out the valuation models, check our safety buffer, and then ultimately render a final decision.
All right, Section 1, the business and its economic moat. Let's understand exactly what OSCR does.
In short, they are trying to drag the massive, honestly kind of archaic U.S. health insurance system kicking and screaming into the modern age. They're sitting on trailing 12-month revenues around $13.3 billion with a record 3.4 million members. It's basically a highly consumer-friendly app paired with this proprietary AI system for pricing and risk.
Now, applying a strict Buffett checklist. Is the business understandable? Yes, but we've got to rate their economic moat as only narrow. Why? Well, because while their tech stock is definitely giving them an emerging cost advantage, they just don't have consistently high returns on equity yet. I mean, the trailing 12-month ROE is sitting at negative 2.6%. Plus, their earnings are massively sensitive to government policy, which creates a lot of unpredictability. That being said, we are seeing a totally fascinating, highly shareholder-friendly shift under CEO Mark Bertolini. He essentially took the company from this cash-burning land grab mindset to a strategy of incredibly disciplined execution. They're literally pulling out of weaker geographies and focusing on unit economics, proving they can be really honest, capable stewards of capital in a tough environment. Okay, Section 2. Deep financial analysis. Let's look under the hood and see if the numbers back up the story. Just look at this contrast. It's like night and day. They posted a massive $443 million net loss in 2025, but then completely flipped the script with an explosive $679 million net income surge in just the first quarter of 2026 alone. This was heavily driven by their medical loss ratio, which you can think of as their cost of goods sold, dropping all the way down to a super lean 70.5%. And the efficiency gains are showing up everywhere. Their selling, general, and administrative expenses, the SG&A ratio, dropped to 15.2%. That is a fantastic indicator of operating leverage at work. As their revenue scales up toward management's $18.7 billion guidance, those fixed costs are shrinking relatively, which is just driving pure profit directly to the bottom line and widening that narrow moat. Now, their balance sheet has a dynamic that might make you do a double take. You see a 28.9 times debt-to-equity ratio, and your value investor alarm bells probably start ringing, right? It looks terrifying. But wait, they are sitting on a staggering $4.8 billion in cash as of Q1. That giant liquidity pile acts as a fortress, giving them a healthy 1.1x current ratio and mitigating tons of near-term execution risk. I do need to point out a quick caveat for our Buffett-style analysis here. To calculate true owner earnings, you have to subtract maintenance capital expenditures from your cash flow. Because their filings don't explicitly separate maintenance CapEx from growth CapEx, we had to make a conservative assumption that all $8.7 million in their Q1 software purchases was for maintenance. But honestly, even with that penalty, their free cash flow generation in Q1 was incredibly strong. Moving right along to Section 3, valuation models. Let's see how we should actually price this business.
We are attacking the valuation from three distinct angles: a discounted cash flow model, the classic Graham formula, and a multiples comparison. Now, because the raw filings don't spoon-feed us a specific weighted average cost of capital or a risk-free rate, we are assuming standard historical market averages to build out these models. Let's start with $2.07. That is their Q1 diluted earnings per share. If we plug that highly profitable quarter into the Graham intrinsic value formula and assume a fairly conservative 7% long-term growth rate based on their own revenue guidance, well, the base intrinsic value stretches up into the mid-$20 range. It looks highly favorable. We're completely skipping the dividend discount model because they don't pay a dividend. They reinvest every spare dime right back into the business. But running a reverse DCF on their current market valuation reveals something crazy. The market is essentially pricing in very low single-digit cash flow growth. It's like investors are totally discounting the massive 52% revenue growth they just posted. Looking at multiples, and since their historical PE is negative, price to sales is our best metric here. OSCR currently trades at roughly 0.4 times sales. That puts them right at the bottom end of their Affordable Care Act peer group, which ranges from 0.3 to 0.7 times. So relative to the industry, they are cheap. If that newfound Q1 profitability holds steady, there is substantial re-rating upside here. All right, Section 4, the margin of safety. Do we have a buffer if our assumptions are totally wrong? A true value investor doesn't just happily buy at intrinsic value, right? We demand a massive discount, usually at least 25 to 30% below that value. That's our safety net to protect against unforeseen policy shifts or a sudden spike in medical costs. So, at the time of these filings, OSCR's stock price was sitting right at $21.31. This is the exact number we have to measure our required safety margin against. And this brings us to the ultimate tension for us today. While our base case intrinsic value estimate is up around $25.90 per share, applying our strict 30% margin of safety dictates a maximum buy price of $18.13. So what does that mean? It means at current prices, the stock is just a little too expensive for our strict value parameters. Which leads us to our final section, Section 5, the final verdict: buy, sell, or hold. Here is our one-paragraph thesis. OSCR Health is a rapidly improving business, for sure. Their SG&A leverage is genuinely working. That Q1 net income of $679 million is stellar, and they've got $4.8 billion in cash. But, and it's a big but, the historical volatility of the ACA market and their negative trailing returns on equity demand a pricing buffer we just simply don't have at today's valuation. Therefore, answering Warren Buffett's question, while it is certainly becoming a wonderful business, it is not currently at a highly discounted fair price. So our clear and impartial verdict on OSCR Health is a hold. Patience is a virtue here. We wait for a broader market pullback to hit our $18 entry point. But as we watch their next quarter unfold, you really have to wonder, will their AI and tech advantages finally make them bulletproof against the chaos of government healthcare policies? Or were those massive Q1 profits just a temporary seasonal peak? You're absolutely going to want to keep a close eye on their upcoming filings.